Hey everybody, this is Unit 6.4. We're talking about the effects of policies and economic conditions on the foreign exchange market. Now this is our second video in this subsection, and in this video we're mainly going to focus on the effects of policies on the foreign exchange market. Now what do I mean by policies? I mean monetary policy and fiscal policy. What we're talking about is changes in either monetary policy and or fiscal policy in the United States or in the rest of the world, because no matter what, if fiscal or monetary policy is being changed somewhere, it's going to have an impact on the exchange market that, conceptually sits between countries. Now in this video, we're going to focus on monetary policy, and the change is going to be coming from the United States, okay? It's going to be coming from the U.S. Central Bank, which is the Fed. And what we're going to have happening in this video is the Fed is doing an open market purchase. They're buying assets, usually U.S. Treasury bonds we could think of, from the financial markets, okay, from the banking sector. So they're going to buy these U.S. Treasury bonds from banks. Why? Most importantly, to put reserves into these banks, okay? So again, this is an open market purchase. This is in a form of expansionary monetary policy. So the reserves are heading into the banking sector. Now, why are they doing that? To increase the lending ability of banks, okay? They're putting these reserves in to drive the interest rate down, okay? Just the same way that if we drove up into a farmer's market and there was a bunch of apple stands and we put a ton of apples into those apple stands, like we said, hey, apple stands, I'm just giving you guys more apples. What would happen to the price of apples? They would go down at that farmer's market. Well, that's kind of what the Fed is doing here. They're putting more reserves into the banking sector. And hey, what's going to happen to the price of loans if we put more reserves into the banking sector? They should go down. So the interest rate is going to go down. That's what the Fed is trying to do, is drive interest rates down. So again, open market purchase, expansionary monetary policy, driving the interest rates down. How is that going to affect our exchange markets and, our financial account and our current account? Because again, we're always integrating our knowledge of exchange markets with the balance of payments. So let's take a look at it. The first thing we want to think about when we have an interest rate change is, of course, financial markets, and then we want to talk about savers and borrowers, okay? Sometimes I say borrowers and lenders, but remember, in economics, a lender and a saver, they're pretty much the same exact thing, okay? So again, when I take my savings to a bank, I'm lending my savings to a bank so they can lend that money out to others, right? I'm supplying loanable funds, right? So again, just get used to always using savers and lenders interchangeably. Now, so again, interest rate change. Think financial market. Think financial market. Think borrowers and savers. Now, which one should I think about? Well, I like to think about savers, and the reason that is savers go through exchange markets because savers have money. Borrowers don't need to go through exchange markets to get to financial markets, right? The borrowers just can go straight to the financial market. They don't need to exchange anything to get into a financial market to borrow money. Savers, they're the ones with the money, and I want to watch which way money flows, okay? Because I want to know how money's flowing through this exchange market. So I really think the key here, guys, is think about how savers are going to react. The people that have money, the people that go through exchange markets. So U.S. savers, how are they going to react to this? Well, heck, I don't like lower interest rates, nor do any other savers, okay? Now, if I was a borrower, I would, but again, I'm talking about savers. Savers don't like lower interest rates, so what will U.S. savers do? They're going to want to go put more of their savings in financial markets in the rest of the world. So how's that going to change things here? Well, to do that, they're going to have to supply their dollars. You can see we've got the dollar market right here. They're going to supply their dollars. So the supply of dollars is going to shift to the right. There it is. That's the reaction, I like to say, of U.S. savers. Truly, it's the reaction of anybody that has, financial assets here in the U.S. financial market. Because again, it could even be a European who now wants to liquidate their financial assets because of the lower interest rates and wants to now move their wealth back here. And again, when they liquidate their financial assets, they would be paid dollars, and so they would supply their dollars. But again, for simplicity's sake, I like to think kind of just about the U.S. savers when I think about the supply of dollars when it comes to an interest rate change. Now, how are European savers going to react? Well, they don't want to put, weird pivots here, they don't want to put their money here anymore, or not as much of their money at least. Sure, they'll put some because they want to diversify, but they're not going to want to put as much as they used to. So they're going to supply less of their euros demanding less of our dollars, right? So the demand for dollars is going to shift to the left. Again, they're going to supply less of their euros to this market because they're demanding less dollars. So here it is, the demand for dollars is shifting like that. So put that right there, sub-0, sub-1. That was the original, okay, equilibrium. That's where we were. And now what I like to do is I like to slow it down for just a second. Okay, you can see the shift right of the supply curve and the shift left of the demand curve. Now I want to mark the original exchange rate. There's the original exchange rate, okay? And here's what I like to show is, hey, that dot and that dot are now kind of relevant, okay? We want to pause for a second. What is that dot? That is now our new quantity demanded of dollars. And what's that dot? Our new quantity supplied of dollars at the original exchange rate. Now, what that should say to a student is surplus of dollars. That's exactly right. We're going to have a surplus of dollars at the original exchange rate. So what's going to happen to the exchange rate? Of course, it's going to go down, right? The price of dollars is going to go down. If we have a surplus, again, quantity supplied greater than quantity demanded. I've got this horizontal view right here. At this exchange rate, the quantity demanded is that much, the quantity supplied is that much, surplus of dollars, the exchange rate, the price of the dollar is going to start heading down. It's going to start to depreciate, right? And as that happens, something very important is happening, okay? As the dollar depreciates, and I like to go right here and put dollar depreciating, this stuff is becoming cheaper to Europeans or anybody else in the rest of the world. Of course, I have rest of the world. A lot of times I just kind of say Europeans, but of course it could be to people in Japan or China or anywhere, right? Australia, it doesn't matter. Just people in the rest of the world. This stuff is going to become cheaper, all right? So why is that? Again, the products sold here are priced in dollars. The prices aren't changing, right? The amounts on the price tag of goods and services is not changing. But the dollar is becoming cheaper. If the dollar is becoming cheaper and the prices aren't changing here, this stuff is becoming cheaper to people in the rest of the world, right? And so they're going to want to come and buy more of this, which gives us the following right here. This little movement. You see that movement? What's important about that is it is going to the right, okay? Don't focus on the down part right now. It's going to the right. Right means increase in the quantity demanded for dollars. Now, who's doing that, okay? Well, the first thing is I want you to understand movements are due to price changes, a change in the price of the currency, okay? And that movement right there, that increase in the quantity demanded of dollars, is people in the rest of the world now demanding the dollar, not because of the interest rate change. We've already shifted the curve. We've already got our surplus because of the shift in the curve. This is happening because of the change in the exchange rate. Again, it's because of the dollar becoming cheaper. And so that's the rest of the world saying, oh, okay, now I'll come back into this place with my currency and demand dollars because, heck, I want to buy these cheaper goods, okay? Now, what else is happening? Well, foreign currencies are appreciating relative to the dollar. And if foreign currencies are appreciating relative to the dollar, this stuff's getting more expensive to Americans, okay? This stuff is priced in foreign currencies. If foreign currencies appreciate relative to the dollar, Americans now see these goods and services as more expensive to them. And so here we go. We're going to get this movement. Okay, what the heck is that movement? Again, the first thing I want to recognize is I'm going left in my graph, right? Quantity is decreasing. It is a decrease in the quantity supplied of dollars. Well, who are the suppliers of dollars? Generally speaking, Americans. And why are they supplying less? Because they want to buy less of this stuff. Again, what's so important to understand here is the shifts right here, those shifts, they happened in response to the change in the interest rate. They caused the surplus at the original exchange rate, the price of the currency. Then price went down, right? The exchange rate went down. The dollar became cheaper. And then we got these movements along the curve because of the dollar becoming cheaper and this stuff becoming cheaper to the rest of the world and this stuff becoming more expensive to the rest of the world so that we will move to this new equilibrium point right there. Our new equilibrium. So once again, that was our old one, okay? And this is our new one. And the market is going to clear and we will be left with a dollar that is now cheaper. At this new equilibrium, the dollar has now depreciated. It's now cheaper than it used to be. Our new exchange rate is right here. Now, as we finish this up, I want to kind of show you what just happened, okay? The Fed pushed reserves into the U.S. financial markets, driving the U.S. interest rates down. This is a relative change in interest rates. Money is going to begin to flow like that, right? Money's going to go that way, causing a surplus of dollars. And then these people that want to go now there are going to have to accept, okay, less euros or less yen or less of any other foreign currency for the dollar. So the dollar is going to begin to depreciate, which is going to get people who are focused on goods and services to now come out with the foreign currency. And then we're going to get the exchange. The actual exchange of the currency is then going place, right? The foreign currency goes that way. The dollar goes that way. These people grab the dollars and head in there and buy U.S. goods and services. These people now get the foreign currency, right? We're seeing the surplus being resolved so that now they can go into those foreign financial markets where the interest rate is now relatively higher. Now, it's also important to note that this movement of dollars is also going to bring international interest rates back into equilibrium also. But I'm not going to focus on that here, okay? We've got enough going on. So hopefully you kind of saw those flows. I like to then put on my credits and my debits. Money's coming out of the U.S. financial account. We're getting debits to the U.S. financial account. Money's flowing into the U.S. current account. We're getting credits. I also want to note what's happening to U.S. net exports. What's happening to U.S. net exports? Remember, this is green for a reason. This is the currency flowing this way. The goods and services are going that way, right? People are coming to buy our goods and services. U.S. net exports are going up. What's happening to foreign financial accounts, financial markets? They're getting credits with their relatively higher interest rates now. And what's happening to the current account in the rest of the world, our current accounts in the rest of the world? They're receiving debits, okay? What's happening to foreign countries' net exports? They're going down. All right, I hope that made sense to you. It's just such an important one, and hopefully you liked it, hopefully you understood it. We'll see you in the next video.